to make each day a brighter day. It's those small acts that go a long way. Go ahead is our determination to rise. Going ahead is our courage to do something new. Go ahead is never giving up in the face of adversity. It means growing our own. It is making the most of what we have. To go ahead. Now, that is the Kenyan spirit. Go ahead is believing to make each day a brighter day. It is showing everyone that we can all be heroes. Going ahead is our courage to do something new. It's those small acts that go a long way. It means growing our own. It is making the most of what we have. It is supporting each other where we can. To go ahead. Now, that is the Kenyan spirit.
Joy?
Yes, Sam. Thank you. Thank you so much. Good morning, everyone. I trust that we are well. We are more than privileged to host you this morning and just have an engagement. I have an engagement more than a presentation on managing personal portfolio. Of course, we are glad that you are our clients and really appreciate that you have been with us for a while. Welcome to our webinar today. We are the KCB Capital team. We are glad that we've had the opportunity of serving you as our clients. So kindly allow me to just go straight to our presentation, to our introductions today. Myself, who's moderating you today, my name is Joy Mukami. Probably I've interacted with most of your clients. I'm the customer service manager with the team. Then we have Linda Kiraithe, who is our research analyst. I'm sure you guys have been receiving our research reports. Linda is the one who's been sitting on that desk and doing that great job. And then we have Timothy Masharia, who is our equities dealer. So matters, stocks dealing, bonds, equity. Timothy is very good with that. So kindly just a little housekeeping. On our Zoom, we can see the place for Q&A or chat. Please feel free as we continue the meeting. Type the questions that you have or any comments that you have, then we'll be sampling them as we go on. So today, basically, like we had shared with you, our clients, we will be handling understanding risk and returns and asset allocation, which will be handled by Timothy Masharia. And then we will have Linda take us through market trend and analysis and investment performance. Just maybe to start us off, I know most of us as clients, what we want to do is minimize our risk, even as we invest. And I just want to start us off with a quote from Warren Buffett, who says that risk comes from not knowing what you're doing. So even as we do our webinar, what we want is just to engage you, give you more information so that even as we continue investing for you and with you, that at least we have more knowledge on what we are doing. So thank you very much. We will go to our presentation. Just give me 1 minute. I'm going to be sharing my screen. Timothy, kindly confirm that you can see my screen. Hello, Timothy.
Yes, Joy. I can see your screen, sorry.
You can see my screen. Thank you very much. So thank you, our clients. As I had mentioned, today our presenters are going to be Timothy Masharia, who's our equities dealer, and Linda Kiraithe, who's our research analyst. Kindly allow me to briefly just give an introduction of who KCB Capital is, who are we. So we are licensed investment bank that is fully owned by the subsidiary, that is a fully owned subsidiary of KCB Group. So basically we sit under the larger group of KCB Group PLC as a stockbroker and an investment bank. So we were set up as an investment arm of the group in order to provide strategic and financial advice to meet the growing and dynamic needs of institutional and individual clients as well as governments. Just maybe to mention, the one thing that we really would want to do as KCB Group PLC is just to ensure that we are one-stop shop for all our clients, for all your financial needs, that you can get investments options, you can get conventional banking products, as well as you can get insurance and everything else that you would need as a client. So kindly allow me at this juncture to hand over the presentation to Timothy, who is going to be taking us through understanding risk and return and also asset allocation. Over to you, Timothy, if you can hear me.
Yes, Joy, I can hear you loud and clear. Our dear listeners, thank you so much for availing yourself for the few minutes you are going to be together to have an engagement. Thank you so much, Joy, for that great introduction. My name is Timothy Masharia. I'll be taking you through investment process management. So how can you be able to manage your investment? But as Joy has quoted from Warren Buffett, the biggest context or the biggest contribution to investments is understanding what you're doing. Otherwise, if there's no understanding, then you learn the risk of falling into unknown traps or loss traps and risk traps. So today's engagement will cover a wide range of issues that affect our journey to investment and how we can better ourselves, from understanding ourselves as investors to understanding the product we are investing in. So I made this presentation keeping in mind that investment at a personal level is 10% technical and 90% behavioral or psychological. Basically, how do we behave? And that is the biggest contributor. So meaning that even without much technical, we'll just do fine if we align our behavior correctly. And to begin with, we need to appreciate the importance of investing. So why are we investing? Why are we in this journey? Why are we even in this webinar? And to answer that questions, we need to evaluate two trade-offs. And the trade-off that happen in our lives. And that is a trade-off between human capital and what we call financial capital. And maybe what we are familiar with is what we call financial capital. But what is human capital? Human capital is a hidden asset. And this hidden asset, it is the present value of future earnings. Everything that you will earn till you become unproductive, till you retire. So that is human capital. We might not know it right now, but for sure, there's a figure. There's a figure of all your future earnings. It might be 10 million, might be 20 million, either from business or salary. So all the amount that you will earn at the present value today, it's what we call human capital. But maybe it's difficult to approximate because there are different dynamics of it. And this reminds me that a lot of in our dating and in family lives, when we are courting or when you're looking at our partners in life, and especially our ladies, we like to refer to looking for a partner with potential. What we don't know that potential is what we are referring as human capital. You want to have somebody that even as much as he doesn't have a lot of assets in the moment, but this person has potential. So we are looking at in the context of human capital, what is the potential of this person? So we are looking for someone with high human capital, much as maybe he doesn't have a lot of financial capital. So financial capital, on the other hand, is the normal amount of asset. The physical asset might be financial, otherwise there may be land, there may be real estate, there might be shares, bonds, or whatever. That is financial capital. So what happens in life as we are young is that there is a trade-off. As time increases, we reduce the amount of human capital. We spend human capital because human capital is a function of time. So this trade-off was very important, since at the depression of human capital is a function of time. So every day that passes, every time you earn some money, either through business or salary, you deplete your human capital. And since total wealth is a sum of human capital and financial capital, then to maintain the same amount of value in terms of wealth, you need to replace the depleted human capital with financial capital as time passes by. Because every time you earn a salary, every time you earn earnings from business, every day that passes, then human capital declines. So it calls for replacement with financial capital. And it might be even and you might wonder, why are we replacing this? Is because the way we are talking about an asset called human capital, which is hidden asset, there is also a hidden liability called the present value of future spending. Today, there is amount that you are supposed to send in future life, and that is a liability. So that liability is also matching with an hidden asset. Now, this present value of future spending, unlike human capital that will end at retirement, this one might even outlive you, because sometimes we'll have to leave inheritances for our children and for our young ones. So we leave inheritances. So this present value of future spending, what you are calling the hidden liability, then that one then outlives you and even lives longer. So we don't just want to preserve human capital or to replace with financial capital, but even replace it more so, because we might use it after even our human capital is depleted. And human capital, approximating it requires some understanding of maybe the kind of business you are and you are in, or the kind of job you are in, because these jobs are affected by different variables. Some jobs are volatile, some others are not. Some businesses are cyclical, others are not. So understanding the type of business that you're in, then it helps you approximate what are the variables that affect your human capital. But you see, on the other side of human liability, or what we are calling present value of future spending, the matching liability on this, that one might not be, because if you are supposed to pay rent, you'll have to pay rent whether business is doing well or not. So the volatility of liability is not much. The volatility is on the asset. So we need to be very careful. We may not have the time to research all investments available, right? We know that a typical rational investor should select an investment with the highest risk-adjusted return. And now this is where now we are going to now discuss now, how do we balance between converting this human capital to financial capital, and how do we convert this? We convert this by basically investing and saving and investing. But now, saving and investing, we have to appreciate that they are constrained, that at a personal level, we are not like an institution. There are so many variables that intersect at a personal level that make us not be optimal. So we are not looking for an optimal solution. So Joy, next slide, please. We are not looking for an optimal solution. At a personal level, we are subject to constraint. And we must recognize that making financial decisions, we face various boundaries that might affect the performance of investment. And for example, an example of this constraint is information. We know that a typical rational investor should select, as I had said, the investment with the highest risk-adjusted return. That is a rational investor. Your capital should chase the highest risk-adjusted return. But the point we are making these decisions, we don't know all the available opportunities available out there. So we are bounded to only invest in what we know. That is one type of constraints that we have. Another constraint is time. We may not have the time to research all investments available. And also our time or time horizon in terms of how long we are investing, we might be constrained. But the biggest of all these constraints is what we call biases. So in the context of constraints, so we are not looking to be the most optimal investors, right? But we are looking to have what we call a bounded rationality, that we are looking to have opportunities or to make choices in investment that, as much as they are not optimal, but they are satisfying our needs. It's what we call satisfying goals. So we are looking at satisfactory decision, though they may not be optimal. We are looking at just what will help us achieve our financial goal. So as I said, one of the biggest hindrances and one of the biggest constraints in our path to investment is what we call biases. And what are biases? Biases are error in judgment. Most of the times, based on our experiences, based on our environment, based on our characteristics, based on our personality, we make wrong judgments, right? And this has nothing to do whether you have done business course or not, or whether you are financial savvy or not. Some of these things are emotional. And we have to agree that everyone suffers emotions. And I'll just highlight some of these biases that we have. Number one of the biases that I'll bring to your attention is something called confirmation biases. Sometimes when you're doing investment, we start from a point of I know, right? And then if you are already biased toward an investment, you look for evidences that support your investment, right? So it's called confirmation biases, a selective choosing of evidence. So you neglect, much as you might neglect even red flags, much as they are just so glaring in your eyes, because you want just to confirm, you cherry pick evidences that support your investment. So that is confirmation bias. Number two is what we call sunk cost bias. Sometimes we are so much invested in things, even if it's your business, even if it's your work, and leaving it becomes a difficult task because there's that mental strength that is needed to just be at peace with the loss, to be at peace and say that, yes, I made the wrong decisions, but it's time to move on. And sometimes this one is very inherent in our day-to-day life. Sometimes you buy a ticket to maybe go watch a movie, and you know, maybe that day it's raining, and the best decision and the rational person would be, okay, I paid for the movie, but it's raining, it's not conducive for me, I might be exposed to flu, but let me stay at home. But then the cost, you already sunk in some money, so you'll continue to the movie theater despite the climatic condition not being in your favor, just because you have sunk some costs. Even in business, sometimes you've made bad financial decisions, right? And business is doing right, but you still continue pursuing those bad decisions, bad ideas, because you've already sunk costs. And number three is something called loss aversion. You don't want to realize, and very related to sunk cost bias, you don't want to realize the loss. The other one is overconfidence. Overconfidence makes you overestimate gain and underestimate risk. And especially the point of underestimating risk. You think that you know too much, right? And this is something you've been doing over the years. And then just right there, you forget about some red flags in that situations, and it blurs your judgment. The other one is an anchoring and adjustment bias. And what happens is every time we are focusing on investment, we tend to think about or we tend to pick something. We put an anchor to a figure. For example, if you're talking about return, you talk about you already have an anchor that a good return should return 10%. So your judgment will be, so we are from 10%. So is the investment giving you more or less than 10%? You already anchored. So it makes you not to be objective on what exactly you're investing. What are the risks in the investment? So you're just concentrating on the return and you already anchored on it. So those are biases. And now, yes, Joy, you can proceed to the next slide. Thank you. So these biases become our either doing or undoing in terms of investment journey. Either we go with regret, or whether we make losses, or we become even worse than the investment that is supposed to help us becomes even worse. So three scholars in finance, and this maybe is a bit of deep finance, but it will help you to understand the context of why behavior is very important. Three scholars in finance, a gentleman called Barriad, Bayer, and Kaiser, categorize behavior and decision making in investment into 5 categories. And these categories, he took extremes of any investor. One, there's a careful investor, and there's impetuous investor. Sorry, and forgive my pronunciation. This is a Queen's language. So impetuous investor. Impetuous is like a reckless investor. So we have an extreme of a very careful person and a very careless person, or a very emotional person. On the other hand, we have a very confident investor and we have another anxious investor. So the intersection of these extremes, then we have a personality type that will help, that can really decide, or can really decide which type of a person are you and what you need to do to get to what we are calling a straight arrow investor. A straight arrow is a balanced investor. So let's start from what is the first intersection. The first intersection from your screen there, you can see is between a careful investor and a confident investor. So this careful investor and a confident investor, this is someone who knows what he's doing. They make right decisions and they do careful analysis. They're independent, they are confident, they are aware, right? but they are susceptible to some biases. And one of the biases that I have discussed previously is what we call overconfidence. Sometimes, due to their overconfidence, they underestimate risk, and so they can get overexposure to some very risky investment types. The other one is confirmation biases. Since they know and they are overconfident, they tend to cherry pick evidences and sometimes, you know, ignore some very glaring red flags in the type of investment they are getting exposed to. That is individualist. Then on the lower left, we have another investor called a guardian. And who is a guardian? This is someone who is very careful. He's very careful not to lose his investment. He's very careful about the safety of his assets. He's very cautious. But then this caution comes because, again, with anxiety. He's very anxious. Might I lose this investment? And what happens is that this person might delay making investment decisions or deploying his capital because he's very careful. He's extra careful. He's anxious. Sometimes he invests and then he pulls funds all together. You know, he's a guardian. Then on the top right, we have what we call an adventurer, right? This is a confident but a reckless person. You know, a reckless but a confident person. This person is very confident, but very confident in a negative way. Because when he does something, he does it recklessly. He doesn't do research. He just believes in intuition. He puts all the money there. You know, these are more close to gamblers. He'll put all their life savings there. He's called an adventurer. And then on the lower right, we have a celebrity. And who is a celebrity? These are people who like to be at the center of attention. But being at the center of attention brings emotions with it. So he's anxious, but reckless, right? He appreciates, he doesn't know, but sometimes due to being at the center of attention, he makes decisions that are just satisfying to the emotions, much as they are not rational. So that is a celebrity. And I hope that I've tackled that investor classification very well. At this point, I want us to take a poll. Joy, back to that slide again. I want us to take just a little poll. And from the training I've done about this type of investor, and I want to be very honest with yourself. There's a very there's a legacy song, back in the day song for some who are loud like myself. You know, please be honest to yourself. And I'm asking with honesty, please be honest to yourself. And I want us to take a poll and tell me, you know, we just want to see what type of investors are we from what we've studied, and tell us what type of investor are you. Okay, what type of investor are you? And I'm going to share the poll, please. Please participate in the poll. Tell us from our training. I hope you can see the poll. Joy, can you see the poll?
Yes, Timothy, I can see the poll.
Yes, please tell us what type of investor are you? Are you an individualist? Are you a guardian? Are you a celebrity? Are you an adventurer? In the next 1 minute, please.
Timothy, please unmute yourself. We can't hear you.
Okay, sorry. Yes, please, let's get to 100 maybe participants. I see we are at 61 now. We are at 61. I can see guardians reading. Guardians, they are taking the read. Where are celebrities? We don't seem to have celebrities among us. Where are celebrities? Straight and narrow, adventurers. Guardian reading, guardians. We are at 66. Maybe, yes, some polls coming in. At 70, guardians still ahead. Guardians ahead. Yes, we are 75. Yes, now I might close the poll. Thank you so much for your participation. Maybe now we can end the poll. Now we can see the results. Maybe I can share the results. I want to share the results with you. Joy, can you see the results?
Yes, Timothy, I can see the percentages.
Great. Now you can see how diverse clients we are, how our personality has affected our investment journey. You can see individualist, overconfident people, self-attribution people. These are people who will blame others when things go wrong and attribute good things to them. Even in our jobs, even I know we work, and maybe where you work, whether you have a business, in a relationship, these are people who are very fond of blaming others for wrong things, but attributing success to them. Those are individualists, guardians. And this is why we have a lot of people. And I think even myself, at one time, I thought myself as a guardian. Now, the importance of this poll is we need to understand ourselves. We need to understand ourselves. So who are we and how does this help us? It's because it helps you to be self-aware. What Joyce said is that, from the Warren Buffett quote is the first point of investing is understanding. Do you know yourself? Do you know what traps you fall in? Do you know what affects you? And when you realize that these are the biases that I suffer from, then can you adjust your biases? Can you ask some second guessing questions that can help you untrap yourself? If, for example, you are a guardian and you know that you suffer from being too cautious, you suffer from loss aversion, you don't realize the loss, you need to come to your senses and ask yourself, is this situation really going to reverse with an honest mind, right? Or do I just realize my losses, if I've made a loss, and move on and maybe look for better opportunities, right? You need to think about, am I too anchored on something? So those are guardians. If, for example, you are an adventurer, there are not very many. You need to think yourself, are you gambling or investing? Have you identified or have you researched on all facts about the investment you are about to undertake? Yeah, don't just follow your intuition. You just need some facts and some research. If you're a celebrity, I know you like attention, but again, I think you need to balance, right? You are anxious, then anxiety calls for researching so that you can be confident about what you're talking about. So Joy, let's go to the next slide. That was just the foundation. Now we go to investment process management. So what is investment, right? Investment is the process of matching objectives, right? So on one hand, you have your objectives and you have your assets. We are calling you the asset owner. You are the investor. You have your assets. And on the other hand, you have what we call investment opportunity set. And these investment opportunities are so many. They're in millions. But also, remember we said that we are constrained because we don't know how many investment opportunities are out there. We just know some of them. So on one hand, you have investments, investment objectives, or your personal objectives. On the other hand, you have investment opportunity set. They're all available investment. So investment process management is the process of matching your objectives, right, to investment opportunity set that can achieve this objective. This process of investment management is referred as goal-based investment approach. And for example, if I just touch on personal objectives, sometimes you have three major objectives in life. And number one is what we call lifestyle minimum. So these are investment portfolio or investment goal that can protect you from poverty, right? And especially when unforeseen circumstances, like for example, today we have the way COVID strike. So do you have that portfolio that can protect you from poverty? And the type of the goal now decides how much risk you are going to take. This lifestyle minimum is some portfolio that's meant to protect you from sliding into poverty. Then it is not very generous with risk. It is not very generous. It is very conservative, because then you don't want to overexpose that kind of investment, which is lifestyle minimum, a protection from poverty, to so much risk. The other one is maybe lifestyle baseline. Baseline is just a portfolio to just help you in the current situation. Things are going well, you have a good job, you have a nice family, just to maintain that lifestyle. That's called a lifestyle baseline. But again, this also doesn't like much risk. It's not very generalized, it's conservative. So lifestyle baseline and lifestyle minimum are not generalized, they are conservative portfolios. So for the investment opportunity set that you're matching them to, then it needs to be a low risk kind of investment or a moderate risk kind of investment, and you need to understand it. But then you have aspirational goals, right? We have aspirational goals for example, holiday. You want to buy a good car, you want to move to a posh estate, you want to, a lot of things, you want a posh wedding. These are aspirational goals. Now with aspirational goals, these aspirational things are not cheap, right? And now you have to trade in a little bit of risk for a better return for you to achieve this aspirational goal. Might be leaving an inheritance to your children. So depending on the objective, then it takes a characteristic of risk and return. You have to balance. Aspirational, you'll have to expose it to a higher return, and then you have to give in a bit of risk. But for lifestyle minimum and lifestyle baseline, then those ones you have to be conservative. Then you have business objectives. They can be return enhancing. Now, depending on, there are various like, credit enhancing, return enhancing, liability immunization. You want to meet some obligation for the business in future, liquidity management. So depending on which objective, then you match it to a certain portfolio. And this is because of a bias called mental accounting bias. Sometimes we don't think money as wholesome. money is not subdivisible, but sometimes we divide it in our mind. So we say this one is for A, this one is for B. So due to that mental accounting bias, then we are able to segregate our portfolios into different goals, and these goals we match them to stability, risk, and return. So that is to it about investment management process. Now we go to what are then these investment opportunities that we are talking about. We are talking about there are very many of them, right? So what are they, and what are these, especially that KCB Capital can expose you to? We call them capital market opportunities, because all investment under KCB Capital are regulated by Capital Markets Authority, and they are various. So I learned through them very fast. Number one is shares, right? Shares. This one I know a lot of you understand. The Safaricom share, KCB is tradable at Nairobi Securities Exchange. For people who are in diaspora, you can buy Facebook shares, Tesla shares. Shares is ownership in a company, right? And then you get it, you get returns in two folds. Number one is capital gains, where the share appreciates in price. Number two is dividends. Shares are medium risk type of investment, and then the suitability, the details are there. One, it helps you in diversification. It hedges against inflation. Sometimes when there's inflation, especially for companies that are able to pass the inflation to the consumers, those are good companies that even in inflationary environment like the current we are in, they are very good. We have a potential for higher gains. It's liquid, it's regulated, so there's an extra amount of compliance that has been done by the CMA. So it's, in terms of safety, it's regulated. Number two, it's rates. What are rates? Rates operate like shares, but what happens in rates is that a company is formed, pulls money from investors, goes invest in properties, then income from properties is distributed to investors. But again, it's also listed so that it can be traded. There are two types of rates. Number one is a development rate, and number two is what we call an income rate. For a development rate, the rate goes and develops the property. But for an income rate, they go and buy already developed income producing properties. And that is what we already currently one of the rates listed in the Nairobi Securities Exchange is an income rate. Income rate, it's called a Fahari rate, is managed by ICA. It was initially under Stanlib. Then Stanlib sold it to ICA Lion. So this it's already there. You can invest in it. And what rates do is that they expose you to real estate. We know maybe we are constrained by how amount of money that you can invest in real estate. Real estate is a high capital intensive business. So we might not have that amount of money to go and develop. So anytime you are buying a rate, you are exposing yourself to real estate, right? It's more of a real estate product. Okay, so if you don't have money to go and do your own apartment, so you get exposed to, you buy a rate, an income rate. There's one called Fahari rate. It's trading very well. They have been distributing returns. I think they own Greenspan Mall and other properties. So you can see it's a good yielding rate. The other one is an ETF. An ETF stands for exchange traded fund. And this one, as a rate, the same thing happens. So amount of money is put from investors. They invest in a specific kind of investment, and then they sell units. But for an ETF, unlike a rate, this one, they don't distribute income. So the only chance or return is through capital gains. And for example, we have one under in the Nairobi Securities Exchange. It's called a new gold ETF. For anyone who needs exposure to gold, now this is your product, because this product is the underlying product on this exchange traded fund is a gold, an actual gold. There's a gold in some safes, and every time you buy this one, you buy a percentage of that gold. So what happens is that when gold prices go up, the ETF goes up, right? So and especially gold is inversely correlated with the economy. If global economy is doing poorly, the gold prices would go up. Like you realized during when Corona came, gold I think went up more than 60-70% because it's inversely correlated. But when the economy is doing fine, then there's that inverse correlation. The other one and the final one I'm going to touch is treasury bills and treasury bonds. And treasury bills and treasury bonds, we have. Let me start with the treasury bill, right? A treasury bill is a discount paper, right? The main difference between a treasury bill and treasury bond is the horizon. A treasury bill is a short lending to the government. And a bond is basically a debt. You lend your money either to a company or to a government, but when what we are calling treasury is because you lend to the government. Okay, so treasury bills, they are short tenured. So you lend for a short term. You can lend for 91 days, for 82 days, for 364 days. Now, the difference is that these treasury bills, due to their short tenure, they don't pay coupon. But what you do is that it's called a discount paper. You pay less for a maturity of more. For example, if you buy a treasury bill of 100,000, then using the interest rate, the return on the treasury bill, we work backwards and decide that since you've bought for face value of 100,000, you'll pay less. You'll pay 97,000, but at maturity, it will mature 100,000. So the additional 3,000 becomes your return. So it doesn't pay interest like a coupon, the way we are used to treasury bonds. So that is regarding treasury bills. Number two, and very important to treasury bills, that all these treasury bills have a withholding tax. So if you buy a treasury bill and maybe it has a return of let's say 10%, then you have to factor in there is a 15% withholding tax. So your net will not be 10%. Okay. Now let's go to treasury bonds. Now treasury bonds, there are two types. There is infrastructure bond and there are fixed coupon bond. Fixed coupon bond, all these infrastructure and the fixed income bond, their tenor is more than 1 year, right? It can be 1 year to 30 years. So the higher the tenor, the better the return. Now, there are two types. There are one called infrastructure bond and fixed coupon bond. The difference is on the tax. Infrastructure bond does not attract tax. So if the coupon is 12%, you get your 12% fully. But fixed coupon bond, depending on how long it is, there's a tax. For 10 years and below, the tax is 15%. The withholding tax on your coupon is 15%. So if it's returning 12%, you minus 15, that is your net. If it is above 10 years, then the withholding tax is 10%, right? Whatever the coupon is, they withhold tax before they pay you coupon. Now, let's go to some components of bonds pricing. What is a coupon? A coupon is those periodic interest that you receive, right? So you'll buy a bond, face value, let's say 100,000. Then if the coupon is 12% and it doesn't attract any tax, for example, an infrastructure bill, an infrastructure bond, you get interest in two tranches, semi-annual. So 12% of 100,000 is 6,000. Right? 12% of 100,000 is 12,000. So you get half of that after 6 months, then the next half after another 6 months. So 6 plus 6 comes to 12, right? But for fixed coupon bond, that 6% you have to minus the withholding tax that matches that depending on the tenor, right? Then what is a price? A price, these are when a bond is issued, it is issued there's a par value on that bond, and what we call a par value. Let me give you an example of what price is from a common analogy that you might understand. For example, for those people who invest in a real estate, right? A building might have a value, right? And let's say the value of building is 10 million, and the return, the length per year is maybe 10 million, a million shillings. So the price of the property is 10 million. And then the land is maybe a million. Now, the price of a property might go up and down. Now, I want you to get that the price of a bond depending on the market situations. There's a relationship between the price of the bond and the interest rate. In fact, the price of the bond is derived from the interest rate prevailing in the market. Sometimes there'll be that volatility of price. So price per 100 will not be 100, right? For a power of 100, you can pay 101, you can pay 102, depending also on how good is the price, how good is the bond. Especially for good bonds like infrastructure bond, you might know the price is not 100. So that is the price. Then you have the principal. The principal is the amount that is coupon is that we are basing our coupon on. Right? Is it a million? 12% of a million, coupon is 120,000. So yield to maturity, this is the rate that we are using to derive the price. It's a bit of technical calculation, but maybe in the next webinars, we might go deep on how we derive the price. Now, then there's consideration. Consideration is the amount of money you're going to pay, inclusive of the charges. There are some brokerage commission, the necessary charges, levies and everything, but they're not much. But also there's something called accrued interest. Now, let me explain something here. That the bond it is pays interest after every 6 months, but you can buy the bond after 3 months. So there's someone who has been holding this bond for 3 months. So you have to refund the interest rate, because at the end of 6 months, you're going to be refunded your interest. So for the accrued interest, so it pegs us on price. So the price we are going to give you is also inclusive of accrued interest. So if you see a price of maybe 103, probably the 2 or even the 3 shillings, all of this is accrued interest, because you're buying a bond at a point where it has already accrued interest, and you need to refund the holder of the bond, since at the end of the period you're going to receive fully for the 6 months, despite you holding for a shorter duration, right? Now, final point is, for yield to maturity, dirty price and consideration, those 3 are market determined, right? Depends on the situation of the market. But for coupon and the principal, those ones are fixed to maturity. Those ones will not change. Your coupon, if the coupon is 12%, it will not change till the end of the tenor. Now, these bonds are tradable. You might sell them in the secondary market, right? So you don't have to hold it, even if it's a 10-year bond, you don't have to hold it to maturity. Now, the final point, sorry, and this is the final, is that there's something called lowering or leading the yield. And what happens? We have said that a bond, the longer the duration, the higher the interest, right? Now, since as you hold the bond, the tenor becomes shorter and shorter, then you reap a capital gain, because the interest of that bond or the yield of that bond will come down. And when the yield comes down, the price goes up. So if, for example, you buy a 10-year bond and then you sell it after 5 years, you'll earn an income, right? A capital gain income, because interest of 5 years is lesser than 10 years. And when the interest comes down, your price goes up. I hope I'm clear on that. So maybe you can, from my explanation, if you didn't understand anything, maybe, for example, you can chat Joy from the chat box. Then Joy will sample some of these questions. We will handle some, and for the ones that we will not be able to tackle right now, then we will make sure that we answer to you either via email or something. So that's the end of my presentation. I hope I've been exciting enough, and if not, apologies. It was not my intent to bore you, but I think at the end of this, you have reaped something, some knowledge that will help you become a better investor. Thank you so much. Back to you, Joy.
Thank you so much, Masharia. Thank you so much, Timothy. First of all, I just want to say that, yes, we have gotten quite a number of things from your end, and I hope our clients that you've also gotten quite a lot from Timothy. I'm sure most of us have known where we fall. Are we guardians? Are we celebrities? At least now we know exactly where we fall. Now, just before probably we go to Linda, I have a few things, a few questions that have come up, Timothy, that I'd want you to address, that maybe I'll pick 1 or 2 before now I hand over to Linda. Timothy, there's a client who's saying, kindly expound more on bond market and digital currency trading risk compared to stocks and bonds. So I think they're looking at digital currency trading risks versus the risk that you face when you're trading in stocks and bonds. Yes, Timothy?
Maybe in digital currency, do you mean the Bitcoins or what exactly? And I want to differentiate something, yeah? Joy, before you follow. There's a difference between trading and investing. And you need to understand as an investor who you are. Are you a trader? Are you an investor? Because for trading, this is someone who comes to the market and times the market, and you want the market to work on your favor. It's a bit of some balance of luck and behavior and, you know, and trend. That is a trader. So this is someone who will come, they are very short term. You can even trade intraday, 1 week, after 3 months. You are not an investor, you are a trader. You are trying to arbitrate the market, right? That's the difference from an investor. An investor, you have to have, I've said you have to have an objective and something you're trying to achieve by that. You have to have a time horizon. There are characteristics, there are things that you have considered on that investment. So there's a very big difference, and you need to define yourself. Are you here as a trader? Are you an investor? If you are here an investor, that is why you need research. You need to know what investment, what is my time horizon? I'm looking for in the next 1 year. In the next 1 year, which is the best opportunity I can expose my money into? And this 1 year, you don't trade today and get out tomorrow. Unless there is an emergency, you are willing to wait. You're willing to see how the market pans in 1 year. If for example, it's a very short term, you don't want maybe to express yourself in a very volatile, in a bit of some volatile investment. For example, for shares, you might consider, since it's 1 year, let me get into a T-bill, let me get to a treasury bill, and again, a treasury bond, but again, it also, what is your goal? What are you trying to achieve? How much returns are you looking? So there's that balance. Okay, and I hope I have answered that question. So in terms of currency risk, there's no currency risk because I believe that unless you are a foreign investor, right, that is where you might face currency risk. But if you are not a foreign investor, there's no currency risk. This is, you are a Kenyan, you're paid in Kenyan shillings, you spend in Kenyan. Even if you're a foreign investor, I see someone from Canada, and welcome so much. Even if you are from Canada, maybe your investment in Kenya is cash denominated, so there's no currency risk. Currency risk is when you invest, for example, in Uganda or in South Africa, where then you have to convert the money the time you're using it to Kenyan shillings. So that's where the currency risk comes in.
Thank you, Timothy. I see most of your clients are asking whether we'll be sharing the session or the presentation. So yes, we'll be sharing the recording of this session to you once we are done with the session, just to ensure that you have at least material that you can also just personally internalize after time. Now, Timo, again, I'm going to ask you one more question. Willie is asking, kindly expound on income from bond using a practical example. For example, when you invest 100,000 for 10 years, and expound on the terms like dirty price, clean price, and rolling on yield. So we'll take, I think, that question, then we'll go to Linda, then we'll handle the rest of the questions at the Q&A after the session. So Timo, kindly take over that question.
All right, thank you so much, Willie. Now, clean price is a price without accrued interest. And I've stated that, you know, as long as a bond has already paid coupon, any other day it accrues interest. So a bond, every time that you sleep with it, it accrues interest. Now, assume, let's take, for example, an example that you've indicated. Let's assume an amount of 100,000, right? Now, the 100,000, you buy a face value of 100,000. Then you want to sell that bond in 3 months, right? Right? There's an emergency that come to you and you want to sell in 3 months. Now, you already had the bond in 3 months, but you want to sell. So the person buying has to compensate you, has to pay the interest of you holding the bond for the 3 months. There is no free lunch in fixed income. You have to pay for that interest because after 6 months, you're going to receive the amount equivalent to holding the bond for 6 months, but you've just held it for 3 months. So now that one, in terms of pricing, we have to factor in that accrued interest. So we have a dirty price. A dirty price is a price that includes the accrued interest. If the bond paid interest today and you sell it today, since it does not have accrued interest, it will be a clean price. Okay, I hope I've given an example. Now, let's go to the other point. Now, a face value of 100,000. Right? You can pay maybe 1,000, you can pay 2,000 because of those two elements of accrued interest and also the price issue. But now let's assume that we bought at 100 for 100, right? For face value, let's just talk about face value. Now, if you bought 100,000 of a bond, and let me talk about maybe a bond, infrastructure bond, because the issue of tax is another discussion altogether. Now, if you bought an infrastructure bond, it does not attract interest. Then you are supposed to receive 12 months, 12, and the coupon maybe, let's work with a love coupon of 12%. So 12% of 100,000 is 12,000, right? But this interest is paid semi-annual. So the half of that, that is 6,000, you receive as for 6 months. Then the other half you received after 6 months. Now, with the bond, we don't have automatic reinvestment. So that coupon has to be paid to you. Then you decide what to do with it. I had seen some question of, can I be reinvesting the coupon? No. It is now, it will first be paid, and then you reinvest the coupon. Yeah.
Thank you, Timothy. The last one, I promise. So Macharia Ngunjiri is requesting you to expound on corporate bonds in Kenya and give examples of bonds that are available in the market. That's the last question we'll take, then we'll go over to Linda. Timothy, that's the last one for now.
Yes, Macharia, thank you so much. Now, currently there are a number of bonds that have been listed in the secondary market in Kenya. But also we have currently we have the primary bond. East African Breweries is issuing a bond currently. It's in the primary market. So the closing date of the bond is 21st of this month. That is on Thursday. Sorry. So that is the closing date of the bond. then it will be listed. I think it has a coupon of, it has an interest yield of 12.25%. The bond is being sold at par, but so there is no bidding. Okay, so the bond is being sold at par, but there's a probability of being oversubscribed. So there might be a proration of your investment. Pro rata means that if they are looking, for example, they are looking for 11 billion, and assume they receive 100 billion in terms of investment. So that means that they'll have to give a proportion of the amount they are looking for. So if you apply for $1 million, you may get less than it. There's another bond, family backed bond. It's listed. But what happens to corporate bonds in our market? They're not very liquid. They're not very liquid. So, and they're not very, so at the point of exiting, you might have a challenge selling. They don't trade like shares or like the other bonds. So I think that is just something I felt I need to mention. So you might realize that most of them are subscribed by institutional investors who are there for the long term, who have bigger sizes. Yeah.
Thank you, Timothy, for that, and thank you, our clients. Now I want to hand over the meeting to Linda, who will be taking us through the current market trends as well as investment performance currently. So Linda, if you can hear me, over to you.
Yes, I can hear you, Joy. Thank you so much for joining us. And I believe now we have learned the kind of customers that we are, and we now seek to assess, after we've assessed the investment market, then how do we know, or at what point do we tell that this is the time for us to join the market or to enter the market? So Linda Kreitha is my name. I'm the research analyst at KCB Capital. And first, we start looking at what is trend. What is a trend? And a trend is a perception or an observable movement for a certain period of time. And first, we look at the trends that are there in the market. So we have a bull and a bear market. And where these names come from, if you look at the two animals, a bull and a bear. So a bull attacks by like jumping in the air, that is by going high, while a bear attacks by fast swiping down or fast hitting the ground before it attacks an opponent or prey. And this is where these markets come from. And with this, then we are able to understand why we say a bull meaning going up, and a bear meaning going down. So we first look at a bull market. So as an investor, how do you tell that it's a bull market? First of all, most investors consider bull markets to be opportunities for exit, and not just, we've been told we can be traders or investors. So not just investors, but also traders. So bull markets offer opportunities for exit, and they also offer opportunities for entry into the market. So what is a bull market? A bull market is a rising market, as we've said, with how the bulls attack. And a rising market is always almost seen when there is a strong or a strengthening economy. So there is positive GDP growth. The government is really supportive on operations in the country. There are favorable tax system. The ease of doing business is easy. So in a bull market, you will see that there's strong GDP growth. There's also drop in unemployment, also that is seen in a bull market. And because of these factors, then in demand for investments and demand for stocks will be high. So most investors are, there is so much money in the economy. So people are looking for avenues and for opportunities to invest their money. And it is in these markets then that people feel offer a good opportunity for them to invest. Also, in a bull market, you will notice that because the ease of doing business is so conducive and things are so good, then you will also see there are very strong corporate profits. So companies are doing well, they are fundamentally sound, and there's so much optimism, so much confidence in the market. And the expectation by investors is that the good or the positive outlook will continue for quite a while. And bull markets offer an opportunity to either buy and hold, especially if an investor is able to detect just the onset of a bull market. Because if you're able to detect an onset, then it means that you can enter in as the price is rising, but then you also expect that the uptrend will go on for quite some period of time. And so you can buy and hold. But other investors also see a bull market as an opportunity for exit, especially for long-term investors or for people who have held the stocks for quite some time. So a bull market then means that prices are up. So if you had bought at a lower price, then it means then it is your opportunity to exit the investment. So an example of a bull market would be, if we remember, when in 2015, the government assented to the financial bill that saw the repeal of the rate cap, but then this was later reviewed. So for those who were in the market at that time, you will agree with me that there was a really high jump in stocks, especially bank stocks. And this was also seen just a general trend and a general rise in the market, with so much optimism that there would be there would be greater lending, people would be able to access credit easily, so the economy would do well, banks would do well, the stock market would do well, given that our market also is also highly concentrated by the bank stocks. And at this time is actually when we saw equity KCB hit above 50 shillings, something that has never been seen before. So that would be a good example of what a bull market is. We now look at a bear market. So as we said, when the bear wants to attack, it first goes down. So this means in a bear market, then we should see a fall in general prices. And a bear market comes now with the opposite of what we've said is seen in a bull market. So we see general economic downturn. So things are not doing well for the economy. Share prices are falling. There's so much panic. There's so much uncertainty and anxiety by investors. So if you look at the market indices, for our market, we have like the NSE 20, the indices are down, and investors really do not know for how long the fall in prices is expected to last. And an example is a very good example of what we are seeing right now. And this is what we saw when the pandemic started. So there was global panic. People did not know what will happen with the pandemic. Is there going to be a financial crisis? So most people, this was seen by both local and foreigners and foreign investors. Most people exited the stock market. So prices were falling, given there was no optimism in the market and the uncertainty of how long the pandemic would last. So a bear market offers for investors in a bear market. So investors can decide to hold for those, especially for those long-term investors who feel that they have already invested in companies that are fundamentally sound and companies that they know that even if the unforeseen happens, these companies are expected to remain strong. So in our markets, we have the banks, we have Safaricom, and true to that, actually, we saw that these companies have been able to actually survive the pandemic and still remain in profitability, despite the fact that the ease of doing business has been bad. Times have been tough. There has been so much uncertainty, and the lockdowns, the economy is not doing well, and so investors can decide to still hold on to these companies. Another option would be for the investors that we've learned about, the risk takers. They would see this as an opportunity to actually buy in, especially because they know that at some point in the future, then there should be recovery, and they should expect to see prices go up. And actually, looking at our market, then we can see that for those investors last year who bought in actually when the prices were down, this year have been able to reap benefits. We saw a case in like for Safaricom, and where at the beginning of the year, the price shot up to above 40 shillings, and this has been the trend. So depending on the kind of investor that you are, from the characteristics that we learned, if you're a risk taker, then a bear market would offer an opportunity for you to buy in. But then the risk still remains in that in a bear market, it is always hard to tell at what point will the market bottom out. So if the prices go down, how low can they go? So because as we saw with the pandemic, the fall in prices was not overnight. It was just gradual as investors continue to observe what is happening, and as they continue to gather information and to understand exactly how long will this pandemic last, to see whether any effects of the government stimulus that we saw are going to be felt in the economy. So the challenge with a bear market now still remains that it is usually very hard to tell whether the market has bottomed out. So even if as an investor you decide to get into the market, then you do not know whether there still remains the uncertainty as to whether you've bought at the lowest price possible, because let's say the price has fallen by 20%, it could fall for by another 20% still. And as an investor then, in a bear market, it all depends with the companies that you intend to go to take up. How fundamentally sound is that company? Because then if the company is fundamentally sound, if it is a good counter, if it is a counter that you know has few liquidity issues, so you know that once things go back, these are the counters that you'd expect to see shine quickly, then you would not have a problem buying at whatever price. Joy, you can go to the next slide. So then, after we've observed the market trend and as investors, we've looked at our opportune entry point into the market, then of course we need to assess our investment performance. So investment performance is an assessment of where you are in the terms of return in comparison to what we had talked about, your investment objectives and your goals. So if your goal was to earn a return of 20%, or if your goal was to gain dividend, how do you tell then that you are making money actually from the capital markets? And for this, first we look at what is total return. So in the capital markets, there are two ways to get return. So from capital gains, and this is from rising prices. And then there's the dividend yield, where you take the dividends that you earn, let's say 2 shillings for KCB, you divide by your entry price for the same counter. So you look at the percentage, that is what we call the dividend yield. So looking at your total return, you then need to compare this return, especially if you're invested in the stock market, you need to compare this return to what we call the riskless return. And what is riskless return? So this is from the government, from investing in government, that is the T-bills and the T-bonds. So you need to compare the return that you're getting from the stock market. If you got in and have made, let's say 15%, then if you and remember that in the stock market, you've taken a portion of risk, because this price could fall, this company could collapse, there could be corporate governance issues, and the price comes down suddenly. So you need to compare the fact that you've taken a stock and there's risk involved. So you compare the return that you're getting from this stock or from the stock market with the riskless return, that is from investment in government securities, that is the T-bills and the bonds. So one way of seeing that you're actually in the positive is to compare these returns. So if your return is above, if your 1 year return, let's say for a stock, is above the 1 year T-bill, then it means you're in the positive and you're making money. So if you compare them to a bond, then it also means you're in the positive and you're making money. Another way to measure your investment performance is to look at the performance of the individual stock versus the performance of stock market indices. And for our market, we have the NASI and the NSE 20. So you look at an observation of looking at the portfolio of stocks that you have, and looking at the movement in the stock market indices. How is your portfolio? So is its performance above or below the indices? Of course, if it's below, then it means that there's still room for you to make more money in the market. And it also means that there's some shortfall in return. So as an investor, you need to identify where the gap lies in terms of the counters that you have in your portfolio, and the counters that are now composed, like for a case scenario of counters in the NSE 20. So on the presentation, you can see there's a graph where I've highlighted a performance of the KCB model portfolio. The NASI has all the counters in the market. So it's an all share index, and the NSE 20, which mostly has the large cap counters. And you can see our portfolio was actually above the NSE 20, meaning our portfolio was in the positive for most of the year. And even as you look at investment performance, Timothy talked about some constraints. So I will include more constraints that you should consider as an investor. So we have inflation. So you need to observe the trend of inflation in the market, because for you to earn a return, you need to factor in the inflation in the market, so that for you to get the overall, or to see in the real return, that is the return that you've made less the inflation in the market, because you know that increased inflation means you're with a certain amount of money. So let's say if you have 100 shillings today, when the inflation is, let's say, 6%, and next year inflation is 7%, then it means next year your 100 shillings will buy less, or will be valued less in terms of buying goods and paying for services in the market. So as we look at our return, we also need to factor in the fact that there's inflation. So you need to add an inflation component to your return. From there, we look at taxes, and this is one of the things that Timothy covered on the taxes that you have on bonds and on stocks. So you need to look at the taxes. So how much are you paying in taxes? Because your return needs to be net of any taxes and also any transaction costs. That is any costs that you incur while making this investment. So if you're paying any management fees, if there's any commission to be paid, then you need to net this also for you to get a net return. And this is the return that you now compare with that of either the T-bills or the bonds, which we said is riskless, and then also compare with the indices to observe just how good your portfolio is performing. And then now looking at the onset of why you invested, that is your goal as an investor. You need to weigh in, if you're a long-term investor, you're probably seeking capital gains and dividends and to see your investment grow. Then you need to see what progress are you making towards achieving your objective. If you're those investors if you're probably investing for inheritance, let's say for your kids, and you want to leave them a good chunk of stocks for them to invest, you need to look at, is your investment growing? Is your portfolio growing? If you invested 10,000 shares, and you invested in a company that pays good dividends, and you decided that every time you receive this dividend, you're not spending it, actually you're reinvesting the dividends and growing your portfolio, then you need to observe if you invested in a counter hoping that it will pay dividends. Is the counter still paying dividends? Because then if at some point there were some issues, capital issues, and the company could not pay dividends for 2-3 years, then it means that your portfolio is not performing towards your goals, and so you're not able to meet your goals. So if you just came into the market to trade and have a return in a short period of time, then you need to observe and see, okay, this stock I bought at 20 shillings, but it has now gone to 18 shillings. And from the trend in the market, then I do not see this stock ever going up, or I do not see a reversal in the price. So you need to evaluate yourself as an investor and see whether you want to keep holding on to the stock, or you want to exit and take in a few losses before maybe the counter goes down probably to below 10 shillings and is trading at a point where you're not actually even able to make the decision to exit. So the investment performance, and as investors, we should invest with a goal, either a percentage return, where we tell ourselves, if the 1 year T-bill if the T-bill is for let's say 9.5%, then it means if I'm coming into the stock market, the fact that I am taking some risk, then it means that I should I should not, I should have a return with that is the 9.5% plus, maybe give yourself a target, maybe plus 5%, plus 10%, so that the fact that you're taking a risk then will be worth for you to actually hold this stock. And that is how then we are able to assess our investments as stock markets. And on this, I think it would be important for me to highlight that sometimes as investors, we just look at the market in terms of this counter is 5 shillings, the other one is 100 shilling, and then we forget about the component of return, where if a stock is for 1 shilling, not let me say for 5 shillings, and it goes up by 1 shilling, then it means you've already made 20% return, where you say the 1 shilling, that is the gain of 1 shilling, you divide by the entry price of 5%, which is 20%. The same case applies to a stock that was for 100 shilling. So if it's 100 shillings and it goes up for 1 shilling, then it means you've made 10% return. So as investors, we need to sometimes, because of our human nature, we look at the zeros, but ignore the percentages, that is the return. And I think then as part of our measurement of the investment performance, we need to factor this in. That is put our returns in percentages for us to see how profitable is it that we're actually investing in the stock market. Okay, Joy, maybe I could take some questions if there are any.
Thank you very much, Linda, and thank you our customers. I think we get to appreciate the different markets that we have, both the bearish market and the bullish market, and I hope it is now more clear on how our investments have been performing, and again also on the constraints that we face as clients, what to consider, things like inflation and tax as we also make decisions. So kindly allow me to just ask a few questions. There's one of our clients who had asked whether KCB Capital does individual portfolio management. Probably, Linda, you can take that up. Linda, can you hear me?
Oh, yes, I can. Okay, so yes, we do. We are able to advise our clients in terms of how to diversify their portfolios. Because then unfortunately, we are in a very small market where most of the counters that I would call fundamentally sound, because then we would never advise you to enter into companies that have either governance issues or have operation issues, they have debt issues, because then it means that once you enter in, you do not know at what point you could exit. And actually, we have seen some of these counters perform worse, actually, and unable to recover over time. So by looking at how fundamentally sound these counters are, then we are able to advise clients on how to diversify from the banking sector, the telco, that is Safaricom, manufacturing, construction, and insurance. So this we are able to do. Also, we are able to also, the fact that we have offerings in bonds and T-bills means also that our clients can also move some of their money to the fixed income, that is not just bonds and bills. And over time, then once we invest, we can always have a sit-in with you and just to look at your portfolio, what is performing, what is not, and actually make action when there's time. And I think one of the weaknesses that I have identified after for the time I have been in the market is that clients will just invest and just forget they've actually had stocks. So by the time you're coming back to review your portfolio, you're actually on the negative for most of the counters, and these counters, some of them have performed really bad, and you are actually, even as an analyst and as an advisor, it actually is so painful to see someone in the red, and probably there are opportunities for them to exit some of the counters early enough. So one of the key things that even as we highlight and as we realign your portfolio to meet or to suit you, then it is important for you also as a client to also remain alert. Read the news, look at the newspaper. I know we're in a generation where most people no longer read newspapers, but those still remain very important. Look at the newspaper, see what they're saying. If you see there's a court case on a counter that you invested in, try to get information, and you can ask us, do you think this will affect my holding in the company? I remember when KPLC, we know where the price is right now, and you know the journey that KPLC has taken, which is quite sad. I remember when the news started coming in on their issues of corporate governance, from a few issues on procurement and tenders and fake transformers. Most clients, actually, I would say, people who are keen to hear those news and to actually exit then, I would say are in a better position than people who actually just did not act on it. And right now you see where the shilling is, where the stock is trading at, and the huge losses that this counter has had to take in over the years. So an advice for investors would be, even as we align your portfolio, then it is also good that you also stay alert and stay keen after every like 2 months, 3 months, look at your portfolio also. Tell us if you need to invest more. Tell us what you feel. Do you think we need to change the holdings that you have? Do you think if you had do you think we need to exit? Because let's say if you had coming in with Safaricom at when it was 25 shillings, it's now at 43 shillings. Do you think you need to exit, or do you want to hold it long term? Because I also believe as individuals, our wants and our goals keep changing with time. You might have gotten into a counter just because there was an IPO, but then in time you want to be an investor who trades frequently, or you want to be an investor who gets into counters for long-term goals. Then you also need to keep talking to us also, because once we align your portfolio does not mean that now everything is okay. The stock market is very volatile. Things change overnight. Just a simple news, just a simple headline in a newspaper somewhere, or just gossip somewhere actually has detrimental effects on prices. So yes, we do portfolio alignment for investors to ensure that there's diversity, despite the fact that we're in a very small market, and also an encouragement to all of you to keep talking to us, also to ensure that whatever holdings that you have still align with your goals.
Thank you, Linda. There's a client who's requesting, Masharia Ngonjuri is asking, Linda, could you kindly expound on the outlook on the Q4 of 2021? What do we expect the performance of equities to look like?
Okay, towards the end of the year is reporting season for most companies. So one of the things that is bound to happen is we could see some exits. And towards the end of the year, actually, the stock markets mostly just comes down. So we see a general fall in prices. So and this is still the expectation for this year. And then the fact that we are going into election year means that investor uncertainty and the jitters around what will happen with elections starting to build up. So we might see an exit from stocks and into bonds as people look for less risky investments, because of course, as we've said, the stock market is highly volatile. If things don't go well with the election, definitely this will be reflected in the prices, where the stock market just comes down. So you should expect to see prices come off towards the end of the year, because of the fact that most people are reporting, and also the fact that there's less activity, especially towards from November 15th when the holidays start. And remember that this year, unlike last year, most people are now able to travel. There's more social activity as opposed to last year. So while people concentrate on the holidays, there's little activity in the stock market, and that is also a reason why we should see prices come off. But then for individual markets, Then beginning next year, as the banks release their earnings, we should see the prices recover. Given that, of course, we expect this year that banks' performance is better than last year. And the fact that if banks' prices come up, then generally in the market, as most people realign their portfolios, especially the fund managers, then we see just a general uptick in prices for the general market. So for the end of year prices, we should see prices come off, or we may see prices come off, but then we should see recovery between January to March in anticipation of the bank year earnings. For Safaricom, maybe I should mention this. They're supposed to announce their half-year results in November 8th. So we may see some activity on Safaricom between now and then. That is positive activity with the price coming up. I believe the counter has performed well despite the pandemic and has really remained strong. And the fact that mobile banking or the use of M-Pesa and Fuliza has really been positive, and I would not say really much affected by the pandemic, and also the fact that their earnings from data has also come up. So between now and November, Safaricom. Then early next year. You can proceed, Joy.
Yes. We had lost you a bit. Thank you. So we'll take a few more questions. We really hope to finish by 11:30. We're actually very grateful for your patience. Timothy, if you can still hear me, I want you to take this one up. Eda is asking, what's the current position of Kenya Airways shares? Can I be able to sell them right now? Please answer that.
Thank you so much, Eda. Now, Kenya Airways, you remember, you can't trade them right now. Let me answer that first, because the government had proposed a restructure which they have never come back to advise otherwise. So as the situation as at now is that they're still suspended. So but I think they reopen. They have been having some challenges here and there. I think it's just following up on the news of what might pan out. I saw yesterday, I think on the papers, there were highlights on a potential bailout from the government. So if these things keep coming in, then it might be positive for Kenya Airways.
Thank you, Timothy, for that. So
Joy,
Linda, Brian, yes.
Joy, and before I hand over to you, I want to say something, right? I know Linda has talked about portfolio advisory. We have something called a modded portfolio. Sometimes we are unable to handle every client request that might come our way, right? We have about 50,000 clients. So this is what we do. Linda sends a report every Monday, and if you don't get it, please get in touch with Joy. And that report has our modded portfolio and has some insights to do with what is currently happening in the market. Now, if you require any advice, please reply to that email and giving your current situation or your current portfolio, and maybe Linda will be able to advise. Number two, if you are unable to pick the stocks that sometimes we are not able to know what to invest in, just take, you can see our model portfolio. We have chosen the model portfolio based on fundamentals. We don't guarantee the model portfolio we do very well, but what we've done is that we've gone and done research on those companies and realized that there are companies that are fundamental, they're not supplies. Their supplies might be there, but we have done a due diligence, we have done fundamental research. So it is a portfolio with a probability of doing fine and giving you return. Yeah.
Thank you very much, Timothy, for that. I'm going to pick a few technical questions that have come up in terms of operations. So there's someone who's asked whether there's an easier way of depositing funds to the KCB Capital account or getting payments. So one, I want to recommend, currently we are trying to work on automating those processes, linking our systems, but it's something that will probably take a while. So currently what we usually recommend is for clients to deposit funds into our account. So for the equities, our equities account, the share account number is 1198774703. That's for investing in stocks. And then for T-bills and bonds, the account is 12077600064. So when it comes to payments, I would highly recommend that drop us an email at kcbcapital@kcbgroup.com. kcbcapital@kcbgroup.com. And also, if you're having challenges accessing our reports, or anyone who is not currently accessing our reports, the weekly reports that are sent by Linda, kindly also drop us an email on the same email, kcbcapital@kcbgroup.com, so that we are going to add you to our mailing list. Now, just maybe to mention, most of the accounts that were transferred from KCB custody to KCB Capital, we noticed that most of your accounts did not have emails, or some of the emails were not correctly captured, or some of you have actually now changed email addresses, you have new operational accounts. So kindly also reach out to us on kcbcapital@kcbgroup.com, and we will be able to update your account details so that one, you're able to get our reports. And also I have seen clients who are asking about KCB HISA, which is our online trading platform. So again, most of you who moved your accounts from whose accounts were moved from KCB custody to Capital, there's a challenge of you accessing the platform, because like I mentioned, we've noticed most of your details were not either correctly captured, or some of your details are missing. So kindly also, if you're trying to access the online platform for trading and you're not able to, kindly also feel free to reach us out, reach out to us. On our currently the slide that is shared, we have our contact details there. Please feel free to drop us an email at kcbcapital@kcbgroup.com, or call, give us a call on 0709-812-920 or 0709-812-762. Also, when Linda sends out the report, if you have any queries or any clarifications that you need, you can reach out to her on that email. She will be really glad to assist. So I just want to say thank you very much as we come to the end of our presentation. I'm seeing your post of appreciation. Thank you, Lucy Wakiaga. She says this has been great. Thanks, Joy, Timothy, and Linda. I would have continued to listening to you for another 1 hour. Kudos. Thank you very much, Lucy. Thank you for all of you, our clients. We are very grateful. Like promised, we will be sharing with you the presentation, the recording, and please feel free to reach out to us for any clarifications. We hope to have more of these presentations and engagements, just to ensure that we are at the same page. We also understand who our clients are and what your also evolving needs are. So thank you very much, Vin, for finding time to log in and give us your morning hours to just present to you. Again, I want to thank the panelists. Thank you very much, Timothy and Linda, for the really great insights. And just to conclude the session, I want to finish with a quote by Tony Robbins. He says, "I love quotes, but in the end, knowledge has to be converted to action or it is worthless." So I beseech you, our clients, that whatever knowledge we have gotten here, whatever insights we have gotten here, that we're actually going to put it into action and improve or better our investment journey. So thank you very much. Yes, Timothy. Yes,
and
Timothy.
just before you close, and this is something that I feel is burning in me.
Yes,
I want to conclude by this, as we even say goodbyes, that I know that, and I have had these conversations with a lot of clients, people who have lost money. It is so painful, right? And it goes back to the biases we discussed. Most of us are an adventurer, but when the loss hits, you realize you are a guardian, or you are not ready for the loss. Now, before you put money, I know there are a lot of, we have said matching opportunity with the investment opportunity set. Not everything that is setting a return is an investment opportunity. You need to understand what is underlying asset in that investment. You need to understand it deeply. If you don't understand, don't invest. That is my begging, because sometimes we suffer fools, right? Because we put the money there when things are working, and sometimes we suffer some bias. I not highlight it. It's called availability bias, where we tend to move with hot ideas, right? What are people talking about? what is the newspaper? And a lot of conmans disguised as investment opportunities know your traps, and they'll put media adverts in the newspaper, in TV, and show you some hot investment ideas out there returning 30%. My dear listeners and our dear investors, please, please, please don't invest in what you don't understand. Reach to us, right? We can ask whether we know about such investment. We might not give an explicit answer, but even if not us, take a step of understanding. Don't just chase a return. Don't suffer that availability bias. Don't just go after hot ideas, because then the results are painful. Okay. Thank you so much, Joy, and thank you so much, our listeners.
Thank you so much, everyone. We had a great session. We really appreciate. Have a lovely day, and also a blessed Mashujaa Day tomorrow. We really appreciate you as our clients. God's blessings, and may He take care of you. Thank you so much. Have a lovely day. Bye.